We meet in an hour of change and challenge, in a decade of hope and fear, in an age of both knowledge and ignorance. If this capsule history of our progress teaches us anything, it is that man in his quest for knowledge and progress is determined and cannot be deterred. Because that goal will serve to organize and measure the best of our energies and skills. Because that challenge is one that we're willing to accept, one we are unwilling to postpone, and one we intend to win.
So we're here today with Kristian Hanelt, who's the Managing Director of Ultra Capital. Kristian, welcome to Energy Impact.
Thank you. Thanks for having me, Brett.
Yeah, absolutely. So we'd love to begin by just learning a little bit about you, how you got into the sector. What was your first introduction to energy or investing?
Sure. Well, I grew up on the West Coast in Northern California and went to college on the East Coast and, really majored in rowing in college. I spent most of my time on the Charles River doing that. But, I was very interested in economics in school and got a job offer to move to Boulder, Colorado and work for an energy consultancy right out of school. And so
not a bad place to spend your 20s.
Yeah, exactly. It's a wonderful place to move to when you're not quite ready for the real world and you're sort of half in a college town and half in the real world. And so I moved to Boulder, loved the mountains, was very excited about living out there and went to work for a company called PA Consulting Group. And PA was a consultancy covering the energy industry. We did a lot of econometric forecasting used to value all these power plants that were getting financed and built all across the country. And this was the glory days of Enron and the independent power producer, and so really cut my teeth on the fundamentals of the energy industry and the power industry, working out there.
What was like one of the things when you first got into the sector, and we're just kind of learning about everything and getting up to speed? Can you remember something that surprised you based on maybe what your knowledge of the power sector was before you became an industry professional?
I was surprised how many surfing breaks that I grew up surfing on had power plants that were, associated with them. But in all honesty, I think that this was before renewable energy really had any momentum at all, and I think I was just very fascinated with understanding the way that the dispatch worked according to power prices and load forecasting and just sort of the way that the grid is ultimately managed by utilities.
When you say dispatch, is that like allocation of energy across the grid?
Yeah, correct. It's basically, okay, I need X amount of energy at this given hour. Here's my all the resources available, stacked from cheapest to most expensive, and how do I meet that incremental megawatt hour that's required to to keep the lights on. I think just kind of understanding where all these power assets we were working on their behalf, where they fit into the grid and the dispatch stack was just really interesting to me, kind of with that interest in statistics and economics and things like that. So
it's amazing everything that happens behind the scenes that we don't think of as general power users when we turn on the light switch.
Oh yeah.
It's actually quite complicated.
Now after Houston and whatnot, we're a little more focused on it, a little more aware of it. So I worked out at PA for a couple of years, and then right as that sort of Enron was going bust and that sector was experiencing some real headwinds, I got a call from a recruiter to go to work for a guy by the name of Bill Koch, who's one of the Koch industry's brothers, although he sort of split from the family business a long time ago. And I knew of Bill from the fact that he won the America's Cup, and I come from a family of sailors. So, he had owned a coal mine in Western Colorado, and in the process of mining the coal, encountered a lot of natural gas in the coal seam. So he wanted to capture and sell that natural gas in the coal seam. So he bought the gas rights to hundreds of thousands of acres nearby the coal mine and started a business to explore for the natural gas there. And so I joined that business. I was the third employee or so, focused on the
Wow,
finance
pretty
side
early
of
on.
things.
Okay.
And yeah, and that was, it was again, it was another job in sort of the fundamentals of energy in the oil and gas business, which I really enjoyed a lot.
And they call that upstream. Is that right? Is that the term upstream? Does that refer to where you get it out of the ground, essentially?
Correct. And so I spent a couple of years working for Bill, both in the gas business, but also for some of his other businesses as well. Great experience. Years later, when I'm on panels at solar conferences and things, I'd like to be able to tell people, I've done this in the solar industry. And before that, I worked for Koch brother, where I cut my teeth on coal mining and fracking.
I'm sure it goes over well in the renewables crowd.
But it was interesting because we were the first oil and gas producer in that particular region in Western Colorado. We encountered a lot of pushback from environmentalists, and we did a lot of things for the environment. For example, the coal mine has a waste gas power facility on board now, where they sell the gas that's effectively renewable, or using a resource that would otherwise be going in the atmosphere, and that power is currently purchased by Aspen Ski Resort. So that was a good project to be involved with. But I would participate in some of these town halls, for lack of a better word, around getting our initial wells drilled in Western Colorado to explore for gas, and it was really interesting to me seeing the environmentalists, or really the people that were residents, kind of being incredibly almost violent with how they would push back on any further development out there. There were people with kind of hang nooses in the crowd and everything else. It was very interesting. And so we, being in Northern California at heart, I grew up, very much environmentally focused. And so I kind of felt like the bad guy a little bit, being part of that business. But at the same time, I got involved with some of the oil and gas advocacy groups in the Front Range, where you'd understand the impacts of $1 per MMBTU natural gas price hikes on low and fixed income families. And so, I got passionate sort of leading up to going to business school with sort of the economic trade-off required to have a more environmentally, friendly energy, consumption, and also the impacts on needing to do it in an economically viable way.
Yeah, I mean, this is the conversation that I feel is stomped out a little bit too much by some of the climate talk, is energy access and energy poverty, and how much that affects human well-being, just the cost of energy itself.
It's a huge issue, and it's going to get much worse, and it's going to be, I think California is going to be a little bit of the melting pot for where that really meets the road. Because if I could digress from my background for a second, I've got a cabin that's at the end of the line in the forest up in Mendocino County, and I have probably a mile of line that PG&E has to maintain just to go to my 1,200 square foot weekend cabin. And so they're in there every year, cutting all the branches, taking down trees, reducing the fire risk. And I've got 6 kilowatts of solar at my cabin. I don't need to, my electricity bill is $10 a month. So PG&E is spending thousands of dollars to protect my access to that power. And instead, who's paying for that? It's the people that can't afford to really break from PG&E. So I think that there's a real need to figure that out. What I think should happen is PG&E should pay for me to install batteries and go off the grid completely and not have the.
Why don't they?
What's that? Why don't they? I think that the restructuring of the utility revenue model and sort of their responsibility towards people like me, needs to be fixed. And I think that people are focused on it. They just hired a guy named Jason Glickman a few weeks ago, who is going to be an EVP of short and long-term strategy there. And I know him a little bit socially, and he's got a big job. I feel like he's definitely had to answer the call to take that job, because it's a real challenge. And I think that the increased penetration of solar is really going to accelerate sort of the friction around what is the relationship between the utility and its customers.
Yeah.
So going back to Colorado, once I got sort of an appreciation of that trade-off of environmental versus economics, I went to business school. I was fortunate enough to get into Stanford, so I got to go home and go to a great school at the same time. And that was really during the sort of clean tech 1.0 timeframe, where things were really accelerating. And I went to business school knowing that was what I wanted to work on, and because I was in Silicon Valley, I had a wonderful opportunity to network with a lot of the people that were really driving that movement. Did a lot of great internships, worked for a lot of great VCs and companies, and came out of there, and then ultimately ended up in the solar business, where I got in the solar industry in 2007. Started a business with a couple other people named Tioga Energy. We ultimately raised $40 million in venture capital, financed 100 or so commercial projects. That was a really fun business, and I date myself in solar because I date myself by what you paid for your first solar modules, and I think we paid $3.80 a watt for solar modules. And I think now my information's a little out of date. They're probably 30 cents a watt. So
yeah, I remember when my first job out of school was working for NanoSolar, and I remember when the target was $1 a watt. It was like that's what the whole industry was trying to rally around.
Yeah,
maybe if we get there, solar will be a thing.
I know, and we had to raise money. I think the cost of the money we were raising for projects was like 17% was what we figured we were giving these investors, and now that number is 7%. So it's quite a different world, then versus now. So I spent 10 years in the solar industry working for Tioga Energy and then Clean Power Finance, which is now known as Spruce Energy. And in both jobs, I was running the project finance team, so in charge of raising capital for the projects. At that time, tax equity was really the hard thing to raise. You had to really get lucky and have a great story to raise the slice of capital that you needed to monetize the investment tax credit, which was the key sort of subsidy for solar out there.
And tell me more about, though, just like the breakdown of equity and debt for financing these projects, and what were some of the challenges that the investors had to mentally overcome when looking at like a new technology in a new industry?
I mean, it seems funny in hindsight, right? Because solar's come so far and it's so efficient as far as the capital raising side of things now. But in the early days, first of all, on the tax credit side, the whole industry had to go through the financial crisis together, which means that the key providers of tax equity were banks and very profitable corporations, and a lot of them took a lot of write-downs during that period of time. And so the Treasury put in a refundable tax grant or cash grant for a while, but that program had its own twists and turns. So that was exciting. And on the debt side, there's been a lot of advancement on that. I mean, now there's a lot of stuff on the distributed solar side that's done through the ABS markets.
ABS, can you break that out?
Asset-backed securities, so securitization markets, where you're essentially giving sort of institutional investors an opportunity to buy slices of debt associated with pools of assets. And there used to be just a handful of lenders. They used to be relatively expensive, and the transactions used to be relatively complex to close.
When you say relatively expensive, what did the debt providers at that time require in terms of returns? Like 7, 8, 9%?
7, 8, 9, and then you saw deal documents and things that didn't need to be as complicated as they were. So you had solid 6-figure legal budgets per transaction, where it was up to the developers or the originators to be paying all the legal costs, and so you had very expensive law firms that would make things extra complex. You had a lot of concern,
like typical supply constraint on the lender side.
Yeah, you had a lot of concern over who made the modules, and so there used to be this bankability list that, first of all, making solar modules is some people will disagree with me, but in general, they're very simple pieces of technology. There's no moving parts. The sort of variability between one module and another is not that high.
But there was probably some risk about what would the longevity of any given panel look like. I remember I was working on the manufacturing line, and we were really worried about keeping them dry, like applying desiccant to seal them, to keep the moisture out, because that could degrade the life from 20 years to 10 years. And so was that possibly some of the concern, that if they just didn't have the record of how long they ran, that the financier might thought, these panels might not last a full 20 years?
yeah, that was a lot of the concern. And then you had sort of, some novel technologies like First Solar and their cadmium telluride technology. But, I think in general, it was really a lot of new entrants coming out of Asia and a lot of concern that shortcuts were being taken
Oh, like
manufactured.
just cheap Chinese manufacturing.
Yeah. And so,
Stigma, yeah, which
so
is no longer like what people consider to be the case anymore. But back then, I imagine it was still much like, like Chinese toys are cheap, so maybe Chinese solar panels are cheap.
yeah, there's a lot of that. And so it was always, you had to balance kind of this approved list and this bankability list. And there just wasn't a lot of capital out there. And that's changed incredibly, and we'll talk about that. But I mean, there just wasn't a lot of, it was a struggle to find debt. It was a struggle to find tax equity.
So what did you do? Like, it was on you. It was your responsibility.
Yeah, it was my responsibility, and then also my team and the board's responsibility, and my CEO's responsibility. And that was sort of the breaking point for companies back then, was whether they would be able to be successful in capital.
I mean, what was your strategy? Was it just like make a list of every bank and start calling, or what? Or do you hire advisors, or like how did you find the capital?
I mean, it was an all of the above strategy. I think, I think first of all, you had to have a good company that was capable of originating quality projects and executing on them. And that was, if you can do that, capital will find you. But then beyond that, once you've sort of identified the list of potential investors, you had to build a relationship, and there had to be trust, and there had to be, a track record that would make things work successfully. And I think that, at the end of the day, it's a people business, and there has to be a lot of confidence in each other to get these things done. When I think back on 2008 and 9 and sort of surviving the financial crisis, I mean, that's sort of what got us through that, was key relationships with a handful of people that, ultimately were backed by quality businesses and execution, but at some level were based on relationships.
Yeah. And so even with tax equity drying up, it was possible to make these projects competitive?
Well, fortunately, the cash grant program came in at the right time, and I think provided an alternative. The cash grant was an interesting, it was different. It was a different group that administered it than the IRS, and so there was a fresh level of scrutiny on what the rules were for applying for tax credits. But all in all, it really saved the industry at a key point.
And was this like an Obama era program of some sort?
Yeah, correct. It was put in. I'd have to go back and look, but I think it was put in fourth quarter of 2008 or first quarter of 2009. And I think that the Biden administration is very focused on in sort of the renewal of the investment tax credit, or the extension of the investment tax credit, having a portion of it or some level of it that can be refundable as well. It wouldn't be administrated the same way as the cash grant. It would be via it's called a direct pay mechanism, but there is a potential for it to come back, which I think would continue to accelerate some of the financing around renewable energy.
Cool.
Yeah.
So where did you go from there?
So I after 10 years in solar, sort of sitting in the hot seat to some degree on these companies, I was ready to get off the solar coaster, as they call it. And I I was very intrigued by a lot of these other sectors that I thought were sort of approaching commercialization around sustainability. And so I met some of the other founders of Ultra Capital and signed up. And
well, pause for a second, because why? What was this streak in you about sustainability? Like, so you did your job. You helped get the solar industry ramped up.
Yeah.
You could have gone on and done anything, and then been walked around proud at cocktail parties saying, I was there at the start of clean energy and I made it happen. Why continue with this sustainability?
They're not mutually exclusive. I can still I think it was a fun ride in solar, and now I look and I talk. We're still involved in solar, and we can get into that, but I see how the kinds of efficiencies that exist in the solar industry today, and it's I think that my DNA is probably looking for something that's a little bit on the earlier stages of innovation, and solar, as it got bigger and bigger, I still like solar. I'm still involved with solar, but I'm looking for areas where, the traditional solar capital hasn't yet figured out a way to make it efficient yet. And so,
But
I
that
think
stands in contrast to a lot of other equity investors, and certainly debt providers that want to see something that is established and known and has a track record and is the opposite of new. How did you, when you start putting your team together and decided that you wanted to go after new sectors, how did you justify to your LPs that you could make this work?
That's a great question. I mean, I think, our view is that there's a lot of technologies out there and a lot of companies out there that are capable of executing on sort of traditional technologies deployed in a new way. So, for example, we've been involved in renewable natural gas, which is a sector I think has got a lot of legs to it. Basically, creating and selling pipeline quality gas from sources such as landfills or dairy manure streams. A lot of excitement there, a lot of capital kind of going into that space. And, I think you're going to start to see that sector in particular get sort of more mainstream than it's been to date.
So this is essentially methane that would have gone to the atmosphere, been a super potent capture of energy, and then a greenhouse gas. Sorry, I don't know why I slipped there. And then, but instead, you're able to, these newer methodologies are able to capture it, pipe it to a source, and burn it just like natural gas that you find from the earth would burn.
Yeah, I mean, there's two main programs driving that sector. So one is the renewable fuel standard from the Bush era program about greening up the transportation fuel in the federally, and then the other is the California, the LCFS program, the low carbon fuel standard program, and that's a California focused program driven to, again, lower the sort of, or increase the renewable content in our transportation fuel. That one in particular has sort of been really pulling the industry into some of these sectors like dairy manure and those sort of waste streams, because landfill gas has been around for a while. It's shifted over time from using landfill gas to produce power to now using landfill gas to put it into a pipeline. The sort of renewable natural gas from dairies is, I would call it, a sector that's really been a focus in the last 5 years. And, there's a lot of big strategic companies coming into that space right now. So you've got, DTE Energy, you've got Chevron, you've got Exxon, all these folks, Vitol, they're all participating in the big way. And so at Ultra, we've been focused on developing projects that people like that would be interested in being a part of.
Cool. And when you say developing projects, are you doing the sourcing of the facility, or does a project sponsor come to you and then you provide the capital to ramp up their origination efforts?
I think it's the latter. We're not capable of being developers ourselves, so we look for development teams as well as companies that have been in the space and have some capital of their own, but potentially need some capital to co-invest alongside them in the projects that they're working on.
And do you ever spin up a development team from scratch? Like, do you ever hire a bunch of headhunters and put together a good management team and say, go after some of these opportunities that we're seeing on the market?
Sort of. We will definitely partner with teams that are small, have a really good idea, and really help them, through that growth from, a very small team, in our office to a medium-sized team that's spun out and growing. And ultimately, if they outgrow us, that would be the sign of victory for us.
And when you say a team with a good idea, what exactly is a good idea in this space? Is it just like, hey, we see the consolidation of this dairy farm industry, and we see the access to the pipeline, and so we can connect those two dots, or is it something really much more innovative? Like, oh no, if we I don't even know, but if we apply this new valve technology, all of a sudden it opens up these different regions. What do you mean by new ideas?
Yeah, I mean, let me go up for a bit. I think the way that we think about investing right now is we're looking for the points of friction in the energy transition that's happening now. And there's a few truths that are out there that are really driving sort of the types of opportunities we're looking for. So number one is there's a ton of cheap capital coming that wants to invest in renewable energy and sustainability, right? Just billions and billions of dollars. And but their issue is really, how do I find quality places to deploy that capital? Because they are cheap for a reason. They don't want to take a lot of risk, and so they're looking to put money in at scale into projects that are already de-risked. So how do we sort of accept that fact and sort of be part of that ecosystem? The second thing is solar energy is the cheapest form of electricity this planet has ever had, and it's going to continue to scale massively as time goes on. So, that what that means is that electricity in the daytime is going to be free or negative, and and then infrastructure needs to be built around that to sort of support the continued growth of solar and ultimately use that to decarbonize the whole entire grid. And then third is storage is going to be a huge role in that, right? So you're going to see, now you've got battery storage. I wouldn't say it's growing at a great rate. The cost of capital for it is very cheap. It's still got a long way to go to make an impact, and you're going to see, sometime in the 2020s, short duration storage really start to drive out natural gas from the power generation grid, specifically those sort of peaking facilities. Yeah, and then you're going to see long duration storage probably in the 2030s start to drive out the baseload natural gas generation, and coal is going to be phasing out all throughout that period as well. So
yeah, but I guess the problem that I've heard, when meeting with authors of the IPCC and scientists around the world and energy policymakers is, while solar is the cheapest when you're in the right time at the right place, those other two things that you mentioned, transporting those electrons and storing those electrons to translate it through both space and through time, you have to factor those costs into a total system cost, which makes it no longer the cheapest possible energy source. And so we still have to, it seems that there still has to be other energy sources that are brought to market to get to where we want to go with our total decarbonization goals, to actually beat out fuels like dirty fuels when it comes to producing heat, for instance.
Yes and no. I mean, I think what you describe are the pinch points that I'm referring to. Okay. For sure. In that case, it's kind of like, well, the reason why it costs a lot when you ultimately get it to where it needs to be is because the transmission infrastructure in our country is not where it needs to get to. And candidly, I think that's where the federal government really needs to step in its infrastructure plan to get the grid to where it wants to be, because what we've seen is a lot of solar projects, don't make sense or aren't as attractive as you expect when the cost of that infrastructure layer on top of the cost of constructing the solar facility.
Yeah, but and listen, all that's great from a U.S. and a clean air perspective, but from a climate perspective, I think the problem still remains that you have to solve it on a global basis, which means that you don't just have to build the transmission infrastructure here, you have to build it in India and and everywhere across the world where they have impoverished people who are just going to look for the cheapest solution no matter what. If you want to solve the climate problem, the clean air and clean energy for America is I think is pretty solvable by getting after these pinch points.
Yeah, I think that's right. I mean, well, let me talk a little bit about kind of where we've been focused on that. I mean, we see a lot of friction being created by where the solar penetration is going. So you're seeing value shifting from energy to capacity markets, because as you saw in Texas, you can have all the renewables you want, but if the sun's not shining, or if the transmission is constrained, doesn't allow all the solar in West Texas or the wind in West Texas to get to where it's needed in Houston, it doesn't matter. So we're looking for, where are there strategic assets locationally on the grid that we can perhaps deploy solar or storage and do that. So there's a lot of focus on identifying resources that might be able to be a better development asset than ones where they're ultimately going to be constrained for transmission reasons. DG solar. So obviously, everybody wants solar close to the, on the rooftop and close to the load. There's been a couple sectors that we feel like have been kind of ignored from the distributed solar, movement to date, and really a lot of that is around, commercial properties. So the sort of paradigm where you've got a small to medium-sized commercial real estate owner, they have a tenant under a 5-year lease. Can't really finance a project with the PPA like the Walmarts and the Amazons have been doing. So you need to have sort of an innovative product to get solar on that real estate owner's rooftop. And then a lot of so those are two things in the electricity industry. The sustainability sector, we've been really focused on RNG specifically, and we've developed a few projects. We've learned a lot over that time period, and we think that there's going to be a lot of opportunities to invest alongside development teams that are also bringing their own projects to market and leverage what we've learned to date, which is
cool.
Not all positive, but educational nonetheless.
Yeah. What are some of those hard lessons?
It's interesting. I think that when you're a developer, you have an idea of what your project's going to cost, and it's going to cost this much, and I'm going to raise this much from debt and this much from equity, and I'm going to have a nice big ownership stake when I can pay those guys off. And so you start building this project, or ideally you start engineering the project, and the costs keep ticking up. But finally, you've got your turnkey engineering, procurement, and construction project. You've got somebody on board who says, I'm going to build it for this many millions of dollars. This much is going to come from debt. This much is going to come from equity. But you get your project built and you're on budget. You're feeling pretty good about it, on schedule. But maybe it takes longer to ramp up to what you expect it to be than you want, or maybe it takes a while to get registered under one of these incentive programs that the federal government or California is administering, and all of a sudden you have a need for a partner who can come in with capital and get your project stood up until it's actually operating as the pro forma model said it would. So we think we've got a lot of experience kind of going through that process, where a lot of other people are coming through that process right now, and we think there's some opportunities there to help folks out.
Have you guys made like an internal playbook where it's like, hey, here's our Bible for not running into trouble? Watch out for this law change. Watch out for this permit from this agency.
I mean, everybody who's in project finance has like scars on their back that they put the mirror and look and they can, find those and keep them forever. But we've invested a lot into internal resources and processes. We've got an internal software system that we've developed that helps us with project risk management and both financial risk management as well as scorecards and a lot of data input. And so we do like to think that we're somewhat structured in how we go about evaluating these projects. But so much of it at the end of the day comes down to people and judgment and guts and having those things that you can't exactly put on an Excel spreadsheet.
Yep. And then what about project size and type? What's your guys' sweet spot?
Yeah, great question. We've done, our smallest investment has been a $5 million commercial solar portfolio that's we hope going to be a blueprint for larger investment down the road. But we did the pilot project, and it was a first time product, again focused on those kind of rooftop owners who have been underserved, I think, to date in terms of solar projects. And then we've done probably about $110 million at this point agriculture waste to ethanol project in North Dakota. So it's a project that takes sugar beet waste and potato waste and makes ethanol. And we commissioned the project starting in March of 2020, so right into the teeth of COVID. And for a good chunk of 2020, we made ethanol for hand sanitizer purposes. So we were in the hand sanitizer business for a while, and now we're transitioning back to vehicle fuel. And so that's a really exciting project. So that project, north of 100 million. But I'd say in general, we are on the smaller side of infrastructure investors. So our sweet spot might be more 20, 30, $40 million.
And when you say, yeah, sorry, maybe I just misheard you there, but when you say when those numbers that you were giving, is that total project cost or is that the equity component?
Total project cost, yeah. So that project was financed with debt and equity.
Okay. And then so for the equity component, your guys' sweet spot for coming in is what, 10, 20 million?
10 to 40, 10 to 30, something like that. Yeah.
Okay.
You know, we use debt. We don't, you know, it's nice to have all equity at times and sort of have the, you know, not have the discipline of debt hanging over your head.
Yeah. Tell me about that. Why do people choose not to use debt? Why not take it if it's available?
Well, it's not a question of using debt or not. I think it's a question of when to put on debt, right? So if you're doing, you know, greenfield developments, or if you're acquiring an operating asset with an eye towards optimizing it or rehabilitating it in some way, shape, or form, you know, you can have a lot of flexibility if you build an asset, get it operating the way you want it to, and then bring on cheap debt. It can be, you know, more expensive to bring on more expensive debt, you know, earlier on, and then if the projects don't work as you expect to, it can put a lot of, you know, stress on debt service. And it's nice to not have that hanging over your head, at least for that period of time that you're bringing the project into compliance.
I see. Got it. So yeah, if there are risks out there to the project itself, maybe the way it runs or some integration of some technology or the performance of the asset itself, or, you know, whatever fuel source you're using and its availability, a bank could look at that and say, you know, we're not just going to charge you 5%, we're going to charge you 9% or something. And that makes the economics much worse. Is that the type of stuff we're talking about?
Yeah, that's one big thing. The other thing is, let's say I'm building a $50 million renewable natural gas project. Now, a lot of these on paper have unlevered returns that are really, really attractive, because
Like what? What's an attractive unlevered return?
well, on paper, you know, so if you are selling dairy renewable natural gas into California right now with a well-designed project, you're making north of $70 an MMBTU for that renewable natural gas. So normal natural gas right now is selling at $3 to $4. So, you know, the premium for renewable natural gas is huge. And so people see that and they get really excited about these projects and they model them out and they say, I'm going to make a 25% unlevered IRR on this project. So, and, you know, a banker is going to look at those cash flows coming off those projects. And let's say it's a $50 million project to construct. You know, you might take those cash flows and apply a discount to them, what they call a debt service coverage ratio. And then you might present value the cash available to pay debt service back to the present day. And on paper, it might say that project can support $70 million of debt. Well, no banker is going to give you $70 million to build a $50 million project, right? They're going to want to make sure you have skin on the game. So, you know, I have a couple options as a developer. I can borrow what most people will give you to build something, which is, you know, you might be able to get 70, 80% debt financing based on the construction cost of the project. But those lenders might want to put in some prepayment penalties if you want to get them out of the way earlier, right? So rather than put in $20 million of equity and $30 million of debt to build a $50 million project, if I really believe I can get that project performing the way that my pro forma says, I should build it for $50 million and then borrow $70 million, you know, once it gets stabilized, and then I've made money on it and I still own the project. So, you know, there's an example on paper of where it may make sense to not put debt on the project, and where when you're commissioning that project, you're sure happy you don't have to make your debt payments while you're, you know, still ramping up your operation.
Yep. And so what's just so we can like help like levelize across different types of projects, what is like a typical debt service coverage ratio that you might apply in your modeling, like 1.4 or something?
It depends on the sector. So, you know, solar, it's been coming down and down and down and down and down, and now you're seeing like 1.25, which is still too high in my opinion. Shout out to the Kilowatt Analytics and other companies that are trying to, you know, create a mechanism to pull down that service coverage ratio. But I think the newer the sector, the higher the coverage ratio. So, I think 1.4 is probably the low end of what what an innovative technology, innovative sector might be able to get. And 1.5, 1.7 is not even another question.
And then a target unlevered IRR for that that people will take a project very seriously, but not think it's astronomical because of some subsidy applied. What are we looking at? Somewhere between 10 and 15%?
I mean, the range is so huge, right? It's like in terms of what you see out there, and especially, the more innovative the sector and the more, the less the track record of the sector, the higher the pro forma says it's going to be. But, I would say we consider ourselves looking for, higher than market infrastructure returns in terms of, where renewable energy and where down the middle utility scale solar is clearing right now. Like we can't compete with that. There's, that's gone to the pension funds and the insurance companies at this point. But, if you think about one or two concentric circles outside of that sector, maybe 10 to 15%, returns, those are kind of where we look for things. Most of the projects, we look at when we first see them, they have returns much higher than that, right? And then you start applying contingencies, you start getting engineers to start designing things, the costs keep ticking up, and you end up kind of in that range anyway.
Isn't that amazing? That's where everything ends up at the end of the day. Across so many different technologies, so many different energy sources, always just kind of ends up there.
But that's a lot of what we do at Ultra, which is, we're not writing 9-figure checks. So, a lot of where we are adding value is we're taking those projects from when the developer might think they're ready for notice to proceed and that they're construction ready. They're not at all construction ready. And so we'll come in, we'll bring in the engineers, we'll bring in, the bankable construction contracts. We'll do a lot of that stuff and package projects in a way that they're actually ready for, deeper capital sources to come in. And in that way, we create a lot of value for them and us. And so
that's amazing. And when you say bringing the engineers, what does that actually mean? Is it like EPC, engineering, procurement, construction firms that you like to work with in the past? Is it just people that check it out over the project? What role do these engineers play?
It depends on the sector and kind of what's appropriate. And when we first got into some of this R&D space, there was no firms were willing to do a turnkey engineering, procurement, construction contract where they're guaranteeing schedule, price, and performance. And that's changed over the last handful of years. There are folks that are doing that now, but the best thing to do to ensure that you can deliver those projects is for your own benefit is to spend, maybe could be $200,000, could be $500,000, but spending that engineering money to really go through and identify all the pieces of equipment that are going to go into that project, all the pipes, all the wires, and do what they call a kind of maybe an FEL 30% sort of engineering work, which will then allow you to take that project and really feel like you're getting an accurate bid from the firms that are able to build it and make sure that you feel like you can deliver that project.
Got it. And when you say FEL, that's the front end loading schema for our engineering project design.
That's right.
Okay, awesome. And then just on that engineering firm, do you always work with the same one, or do you pick the firm by the type of technology?
It depends on the type of technology, and we do see more and more people coming into things all the time. I mean, I think I think where we're focused, on one hand, we're working in some of the more innovative sectors where there is less robust construction firms that have less experience and there's sort of a skill set for managing them. On the other hand, we're doing large scale solar battery development or even rooftop solar development, and there you can feel like quite comfortable that there's dozens of firms that not hundreds, and there's certainly some that aren't qualified, but that there's a lot of firms that will sort of meet the requirements that we have around schedule, cost, and performance.
Yeah. Okay, so we talked about some of these newer innovative technologies. You mentioned solar plus storage. You've mentioned renewable natural gas. What are some other technologies that you've looked at and are, let's say, either that one might not think of, in the common discourse, but that like you guys have invested in, or one that's just like right outside what you feel comfortable investing in, but you're seriously considering it? What's on the breaking edge of innovative?
Well, for me, the breaking edge is hydrogen, because I've been in the industry for a long time. I know a lot of smart folks, and when I talk to my smart folks and friends about hydrogen, I get very passionate answers on both sides of the, the equation of what the potential for hydrogen is. And so a lot of people I respect have really taken very polarizing and dramatic positions on that, backed by a lot of hard science. And so I just don't see me being an early adopter in that space with anything that I'm going to be looking at or originating. To me, a lot of the innovation right now that's fascinating is really around market structure. And we talked about California and PG&E, earlier, but I'm very interested in the way that storage is going to, both in front of the meter and also behind the meter, is going to really start to impact how the grid is operated. So you're seeing companies doing things like the virtual power plant model, where they're aggregating behind the meter down to the residential storage unit. Electric transportation, right? We haven't talked about that, but there's it's another play on electricity is going to go into free and values and capacity. So you see electric transportation. Well, these are big batteries rolling around. You can drive them with free energy, but also store that energy from where it might be needed elsewhere. So I'm really interested in, I think, a lot of that, how those kinds of sectors, models, and basically businesses will evolve as the industry evolves.
And have you ever looked at anything international, or is your domain strictly US?
We have plenty to keep us busy here domestically. The international has got its own kind of unique challenges and opportunities, but I think
it just seems, though, to me, it seems like you guys have learned a lot of the hard lessons here. A lot of countries in their entirety have to go through and learn those hard lessons as they start to implement more of the renewable technologies. It just seems like maybe there's a knowledge opportunity there where you could come in and kind of spot things before the market corrects for it, or that type of thing.
Yeah. Well, some of them are fortunate. They don't have to unwind, something that's been as, established as it has been here. I mean, they don't have to, shut down a coal industry or anything else that's really going to be happening here, where a lot of that friction comes from. So, again, I think my guess is that California is going to be where, the rubber meets the road in terms of, how again, that customer and that utility relationship is going to change, and what's going to happen when you have tons of solar and tons of storage. How do you protect those, low income, customers, and at the same time, create a model that allows the whole grid to get greener and more efficient. So we'll see. I think it's gonna be plenty exciting around here.
Yeah. Okay. Well, I guess from your perspective, seeing how you call it exciting, but really what excites you are the challenges, right? What excites you is the fact that it's new and it's hard and it's interesting and there's problems to solve. But given that, and given just the rate of penetration as it is today, and also given how you have been on the cutting edge of this, in the forefront of renewable implementation, since it really got ramped up, are you optimistic or pessimistic about us being able to meet our climate goals overall, both in this country and the world?
Well, I got to be optimistic, right? Or else we get you out of bed in the morning. I think that. I think it's gonna get pretty. You have to have the friction to create the solution, and I think the friction has not yet come anywhere close to peaking. I think you're gonna see a lot of that friction that's gonna be, I think, coming from that, creating some pretty big movements. Because I mean, honestly, this country's got such a difficult time, enacting anything right now and getting on the same page with any sort of decisions. You have to have the answer clear as day out there, or else you're not going to get movement. So I think it's, I think things will find a way of working out, but I think it's gonna, there's going to be decades of dramatic change around here, and it's, it's starting to be like, in infrastructure terms, 10 years is not a long amount of time, right? And so, 10 years from now, it'll be 2031. You're going to see, long duration storage really kicking out coal and then natural gas. I just think it's going to be here before you know it, that this paradigm is going to be really changing, and it's a really exciting time to work in infrastructure and energy and project finance, because things are going to start happening faster and faster. Last year we got some bills done, but it was like, everything was a drag. And this year it's just got a totally different climate. I feel like I've got a lot of investments in front of us, and they're all going pretty smoothly. Everybody's hungry. There's a lot of enthusiasm, and hopefully that'll just kind of continue for the rest of the decade. We need to step up our game a little bit.
Awesome. Well, I don't think we could end on a better note than that. Kristian, thank you so much for your time today. This has been an awesome conversation, and look forward to many in the future.
All right. Thanks, Brett. Take care.
Our leadership in science and industry, our hopes for peace and security, our obligations to ourselves as well as others, all require us to make this effort, to solve these mysteries, to solve them for the good of all men and for the progress of all people.